All right, guys, welcome back. Another quiet week in the markets. Not really a lot happened over the last week. Actually, that couldn't be further from the truth. So last Wednesday, we reported basically a quiet week in the markets, and with the idea that CPI was coming this coming week, and that would really be the deciding factor on interest rates, and that's what we needed to watch out for. Then come Thursday. And Thursday night, when we saw essentially bank failures with regards to Silicon Valley Bank, with regards to Signature Bank, just a lot of unknowns out there in the banking world, turmoil, if you will, which cascaded into Friday, bonds going crazy, mortgage-backed securities going crazy, treasuries, everything just going all over the place. And this week we got CPI on Tuesday. Josh, not really a lot there. We'll dig into what CPI actually reported here. We had producer price index, retail sales today. But really everything at the moment is still surrounding banks. How the banks do will impact a lot of what happens in the market. So with that said, Josh, welcome. Appreciate you being here.
Just so you know, that's an iced tea, not a 40 ounce there. So the week was highly interesting. It was funny in prepping here, looking at it, realizing the number of things that happened that faded into the background really quickly. Last Friday we had the jobs report for February, and normally that's a big one. I forgot completely about it. I was like, well, hey, look, we had that last Friday.
Yeah. And again, jobs reported a little bit higher than expected, but shows that job growth is slowing. CPI, let's talk on CPI just a bit here, because I think the big conversation is going to primarily be around bank solvency and how that's impacting the market. So CPI basically came in line with expectations. Headline CPI at 6% year over year, 5.5 on the core. Month over month is where we got a little bit of a misread, if you will. And you say, well, how can you have a misread on the month to month if everything else is in line? Well, it's because of a rounding error, if you will. So core CPI was a bit higher month to month, 0.5 versus 0.4. And it basically came down to rounding, more or less in line with expectations. But again, it didn't really have an impact on the market. What's had that impact on the market is really the banks, what's happening here. And what we saw, Josh, is as the crises here in the United States was kind of firmed up with regards to, being backstopped, if you will, by the Fed or what have you, the markets calmed down a little bit. And we actually saw, treasuries move back up. We saw rates kind of bouncing all over the place. And then last night, again, we had 2 days of not really any bank collapses. And then last night we had Credit Suisse come out. And again, we're kind of back in the same thing that we were dealing with more or less on Monday. But again, now you have the, Swiss regulators basically coming and saying that they're going to provide a backstop for Credit Suisse, and therefore we saw
everything's okay. It's all fine now. Don't
exactly.
Look,
so a little bit of bounce
good
at the end of the day. So let's talk about this, and then we'll dive into some charts like we always do, and then get to answering some questions.
Well, Jeb, I want to show a chart because this actually, I'm a mortgage nerd, so maybe this is interesting only to me, but on the right side over here, you see that big green candle on the bottom right? That tells us a couple things. Tells us the market got super spooked last Thursday about what was going on and the potential for trouble with Silicon Valley Bank. So we went from our lowest levels in the last 3 months back to the best level in a week or so. And the thing kind of to look at on these, look at the next 3 candles. You see that big long line above the red, and then in the next one, a big red body and still a pretty big line above it, big line above it. And then today we got a big line above and below the candle. What candlestick charts are a way of sort of measuring market psychology. And when you see those big wicks above or above and below, it tells you that the market doesn't know what to do. There are big ranges throughout the day. So just like Jeb was saying, when we come in the morning and things look bad and the market improves a ton in terms of bonds, bond prices go up, bond yields go down. by the end of the afternoon, the Fed or whatever the authority is in Europe that's taking care of it has stepped in and said it's going to be fine. And then we kind of trade back down. So kind of the important thing to look at here is we're just above that red line there. And I'm not sure which moving average that is, but we popped above in the last week 3 different moving averages on the mortgage-backed securities. So we'll see what happens, because Jeb, we're talking about things fundamental, CPI, PPI, non-farm payrolls last week. Those things, when they move the market, we can say, okay, there's a reason for it. This is almost all driven by the issues going on with the banks, and CPI, PPI, and payrolls basically went out the window last week. So when we're looking at this, it's interesting. We come in and we go, hey, based off of what we think is going on in the economy, this is what's going to happen. And the world just gets shaken upside down by whatever's going on with banks.
Yeah, it's funny. Like a week ago, again, we were talking about jobs being, a driving factor and what have you. And now it's like, no, none of these things are really a problem. Like things are kind of moving the direction that we want them to move. This is a bigger problem. And what creates an even bigger problem is how the Fed deals with this, which we're going to talk about. We're going to look at some charts here in a moment, and how much this all changes. And it's because the Fed starts raising the Fed funds rate, right? So the question is, Josh, I think this is a good parlay into what we're going to talk about, is talking about how the Fed rate hikes have actually impacted banks like SVB and Signature Bank and, First Republic or whatever. Like, how have these rate hikes impacted them? What has the Fed done that's caused some of this? And if the Fed, for whatever reason, decides to help the banks by stopping, a month ago or 6 weeks ago or 2 weeks ago or a week ago, whatever Fed member you want to listen to, and whatever was happening that week depends on what they were saying. But we were talking about getting rates as high as 5.75%, somewhere in that range, if you will, for the terminal rate on the Fed funds rate. Now it's priced in considerably lower, to the point where they were some expectations that the Fed might not even hike next week at all, and they might be done with it entirely. And that's been bouncing all over the place, which we're going to look at some charts. But Josh, how has the impact of the Fed raising the Fed funds rate actually impacted the bank's solvency when it comes to bonds and that sort of thing?
Well, let's vastly oversimplify it
Yep.
for those of you watching at home. The way banks generally make money is they borrow at a low cost from you, meaning what they're paying to you, and then they turn around and invest. What do they invest in? They largely invest in treasuries, a little bit in mortgage-backed securities. So think about where things were during the pandemic. Treasury yields 2% or below, and if you go and deposit money at the bank, they're basically giving you nothing. You're giving them a free loan, maybe a tiny little bit of interest, and they're turning around and getting 1.5% to 2.5% yield on that. So the problem is they bought all sorts of treasuries somewhere in that 1.5% to 2.5% yield. And now the Fed, after driving them artificially low, has now turned around and run them up artificially high. And I say that not that they shouldn't be here right now, but they shouldn't have gone as low as they were. Now they have to go higher than what they should be naturally. So what happens is, if you own a bunch of 2% yielding treasury bonds and yields are now at 4%, 5%, those have lost value. So that's a problem for the banks, in that they have billions of treasury holdings that are now worth less. If they want to sell them, they have to sell them at a discount so that they will still yield what the current interest rates are. And you may only get 60 or 70% of what those bonds face value is worth. So post Dodd-Frank, what the banks get to do is they don't have to mark to market, which means what is the value today? They don't have to put it on their books for what those bonds are worth today. They get to say, oh, we're going to hold those to maturity. That 5-year bond, that 7-year bond, that 10-year bond, we're going to hold it. So we'll get our 2%. We don't have to change the value of it. But what's happening is, now to attract depositor funds, they have to pay 2%, 2.5%, 4% yields. And they're borrowing or investing at not much above that. So they're losing their profit. They've lost value on the investments that they have. And it creates a liquidity problem. When people hear their bank is having a liquidity problem, they go, hey, I'd like my money back. And now they've got a triple problem, because they don't have that. They're allowed to have 10-to-1 leverage. They don't have everyone's money sitting there in the bank. So in a nutshell, That's what the problem is this week. And that is the Fed's role in causing that. They pushed rates too low so that all these banks were overinvested at really low yielding treasuries. And now they've pushed them much higher, and the banks are underwater on their investments because of that.
And so by the Fed pausing or not continuing to raise the Fed funds rate, how does that help a bank out at the moment, Josh? Why are they potentially anticipating, not anticipating is not the right word, but why are some people thinking that the Fed might pause at this point and not continue to hike? How will that help banks out?
If they continue hiking, it will continue to make it worse. Their losses will get bigger. People will have less confidence in the banks and be more likely to pull their funds out. So part of what they did with Silicon Valley Bank is said, hey, we're going to increase banking fees, and we're going to make sure that no one who has their money on deposit there loses money. So they have confidence that the government is going to step in and make sure everyone gets their money back. So hopefully people aren't going and pulling all of their money out of other banks. But in terms of what they do with interest rates, the sooner they can start cutting, the sooner we can get treasury yields down, the better off the banks are going to be. But double-edged sword, what have we been talking about, Jeb, for the last 7-12 months? The Fed is hiking rates to try and get inflation under control. We just looked at CPI. That chart shows you it's trending down, but it's still 2.5, 3 times higher than what they want it to be. So how do you do both things? How do you ease the pain for the banks, restore confidence in the banking system, and fight inflation at the same time? Fortunately, there's reasons to believe, we've been talking about this, and we have some of our friendly trolls here in the audience every week. You guys are crazy. Inflation's going to 14%, and mortgage rates are going to be 22%, and everyone who owns their home free and clear is going to magically lose it. Well, we're talking about forward-looking information, not lagging indicators, leading indicators that are telling us that inflation is easing and moderating. Now, that doesn't mean a lot if we don't get back down to that 2.5% range. If we moderate all the way down to 3.5%, that's still a different world than what we've been in, and it changes lots of asset values. So that's what we're looking at to play out. I am quite confident that this time next year, we have inflation under 4%. Now, the question is, are we 2.25% or are we 3.75%? Because those are vastly different scenarios.
No, good stuff. So with that said, that's a lot to unpack, but let's talk about what's happened in the housing market. As far as rates go, we're going to talk a little bit about rates here in a moment. But inventory hasn't done a lot, Josh. So let's go and get back to the right chart. There we go. So what we're going to do, you moved it. You added it to it. I removed it, blah, blah, blah. So anyhow, total inventory. What we saw this week is another 2% or so drop in inventory nationwide. So we're now sitting at 412,000 homes. That's not a good thing, guys. We talk about this every single week. We need inventory in order to help the problem. The problem is a lack of supply, and we have demand out there that wants these properties. What happens if the Fed starts to pause on this thing? Well, probably allows interest rates to move a little bit lower. What happens with lower interest rates? It creates more buyer demand. What happens when you have low supply and you have high buyer demand? You have, quote unquote, a frenzy like you had last time. Now, are we saying that's going to happen again? No, I hope that it doesn't happen again, but there's got to be something that changes what we're seeing. And at the moment, I don't know where it's coming from. So Orange County today, 2,145 homes. That's the lowest number we've seen since like October of last year. So a very, very low number of properties. Huntington Beach sitting at 153, again, trending in the wrong direction. This next chart here gives you a good idea. So these are new homes that are coming to the market. So new listings that are coming to the market. We're 20% below where we were this time last year with new listings coming to the market. Again, really, really low. This chart essentially shows you more or less the same type of things, just showing, again, 20% fewer new listings than this time last year. And also look at that chart. Go back. Look at the light pink is the number of properties that come on the market and immediately get sold. It's a high number of properties, right? So there are still properties out there that sell instantly. This is a chart showing pending home sales. So the pending contracts with new contracts each week. So what you have here in the light pink is new pending home sales, and then the dark pink is existing pending home sales. So again, you've got 332,000 homes pending. That's 22,000 less, or 22% less than this time last year. Why? You have less inventory for one. You have interest rates considerably higher than you did last year, which is obviously affecting affordability. You just have a lot of different dynamics playing into the market. So there's less pending home sales actually going under contract, which is going to reflect in the total number of sales for the year. So when you see that home sales are declining, or home sales are down year over year, it understood. I mean, you would expect that to happen with everything going on. Number of price reductions sitting about where we were last week. So kind of got a flat line there. So a lot of the sellers out there that have their homes on the market aren't having to continue to reduce price because there is activity out there in the market with the drop in rates that we've seen over the last, 6 weeks or so. We saw rates come down mid-January. They went back up. We're now starting to see them trend down again, which we'll talk to Josh here in just a bit and figure out where rates are today. Again, this just shows, median home price, right, which is actually rising versus median price of new listings. So both are continuing to go up. So new homes that are coming on the market are starting to list at a higher price than they were just a couple of months ago. This is where I think things get really interesting. Anybody looking at probability. So this is prior to SVB last week.
Scott Van Pelt was stepping into the.
You always need a little Sports Center guy on here. No, before SVB and CPI were reported last week. So if you can look at this chart, nearly 65% were expecting a 0.25% hike in March. They were expecting 60% were expecting another 0.25% hike in May, another 54% in June. And then you had another 41% in July, with July basically being the end of rate hikes, taking terminal rate up to 5.75 as we discussed. And then December, you start to see the market pricing in a price cut, right? 25 basis points at that time. Now, after SVB, right? So after all the craziness with Silicon Valley Bank, what we saw was March, 72% of people expecting rates to go up 0.25% and basically stay there. Like nothing happening from that point forward. 0% of people were expecting a 50 basis point hike at that time, which is exactly flopped from what the market was doing. And you had 27% or so people expecting the rate to stay where it is today. And then you saw rate cuts at that time as early as July. Crazy. Then after CPI comes out, what happens? Again, 78% of people expecting a 0.25% hike, 23% or so people expecting rates to stay where they are, 60% expecting another rate hike in May. And then we start backing down from those hikes, if you will, whether or not they're expecting the rate cuts to start as early as June or rates just to stay there in from that point forward. It's hard to tell by the charts here, but nevertheless, these numbers, the probabilities are all over the place. And as of today, it's about 50-50 expecting a 0.25% hike and 50% of the market expecting rates to stay where they are. So I actually put a poll on my channel asking that question. Where do you think rates are going to go? Go on there and fill it out. I would love to know what you guys think. So Josh, PPI came out today.
So the first one there is CPI, the one that you're showing.
Yeah.
And the only reason why I wanted to put it up there, you already ran through the numbers. So look at the chart. The chart is telling us something good, that inflation is moderating, continues to come down. So you may have missed that in the news earlier this week when it comes out, oh, it only hit expectations. Oh, it's only at 6%. Well, that was from 6.4% previously. We are going in the right direction. 6% is not acceptable. 6% is not good. But we are moving in the right direction. And if you've been watching Jeb and I for the last 90 days, we also said that for the first 3-4 months of the year, we don't expect a huge improvement in those CPI figures. And it's strange that the market has been highly disappointed by that, because Jeb and I are not geniuses. We didn't figure that out on our own. We don't pour through this data and go, hey, I think this. as we say every week, we talk to and follow a lot of really smart people. And that was sort of the consensus, that we got 3 or 4 months of sort of blah numbers before things start to improve again, like we saw in the fall. So just long way of saying CPI was a good number, and it sort of didn't get treated that way. But what we did see today, producer price index is more of a leading indicator because it's second tier to CPI. CPI is what you and I are actually paying. So we pay a bunch more attention to this. PPI is what producers are paying. So when their inflation decreases, then they
Is that
don't
like Suge
have.
Knight?
You threw me off with that. What does Suge Knight have to do with PPI?
You said producers. That's what producers pay.
Oh, well,
Bro,
yeah.
come on.
Suge Knight wasn't a producer. He's a
Record
gangbanger.
owner, label.
Dre was the producer. Come on now.
That's
You're
true.
You're talking gibberish over there. You're
Very
throwing me
true.
off. So the important part here is that this was a surprise to the downside. You see forecast there, the highlighted forecast was 5.4%. We actually got 4.6%. And the biggest component of that improved was services inflation. And that has been the biggest problem. If you go back and look at the CPI figures, the hottest portions in there are housing costs, which again, lagging. We've gone through that we do expect within the next 2 to 3 months, we're going to see the decrease in appreciation in home prices and the decrease in increases of rents start to trickle into CPI data. And we're seeing the decrease of services inflation in PPI here. So this is good information, doesn't generally get traded a lot. So both of these things, both CPI and PPI, when we look at those, didn't have a lot of impact. The chart that we showed on the bonds, we can't say that this directly impacts it a lot because it has taken a distant backseat to what's happening in the banking industry. This one here, again, is just another read on inflation. The biggest concern with high job creation, low unemployment levels is that employers are going to have to pay more to get employees, and they're going to have more money to spend, and they're going to go out there and chase the price. There's more money chasing fewer goods, and it drives prices up. So with this, you can absolutely see that we are just back down to the trend. That dotted pink line is the average value from 2018 to 2019, so pre-COVID. So wage inflation is about where it was prior to COVID, despite the fact that we have a so-called really tight jobs market. So when you look at that, Jeb, you had hinted when you talked about last week's jobs report that we had unemployment increase despite the fact that we had 310,000 jobs created. People go, that's insane. How do we create 310,000 jobs, but unemployment was actually higher? 2 separate surveys, the government in their infinite wisdom, they survey households and they survey businesses. Households are saying, hey, we're losing jobs. Unemployment goes up. Businesses, at least in the sample and the way the Bureau of Labor Statistics does that, their survey is saying, no, we actually had hiring going on. So I don't think we have wage growth. We have PPI moderating. We have housing costs moderating. So for all of those reasons, we do expect that CPI is going to continue to improve. The only question we have to ask is how much, and is it enough? This chart, Jeb, the reason why I wanted to throw this one in here, the little purple circle there, that is the middle of COVID panic right there in March of 2020. And what this is the MOVE index. It's basically the bond market equivalent of the VIX. The VIX measures market volatility. When volatility goes through the roof, it says no one knows what's going on and everyone is scared. So prior to this bank crisis here, the number there in March of 2020, Jeb, that's the craziest number I've ever seen. You remember that time? Everyone was looking around going, what in the world's going to happen? Fed comes in with a monster cut over the weekend, which they do not do. So we're sitting here going, why are people panicking? Why are people looking and wondering, hey, what the hell's going on? What happens next? This is why, because bonds are impacted heavily by what the Fed is doing and the uncertainty with what they may need to do to make sure that we don't have any more problems in the banking system. We showed this one before. It's just mortgage-backed securities. Just wanted to show that volatility measure again. These big, long candles are telling us market doesn't really know what to think when you have 100 basis points intraday moves, but then at the end of the day, we close about where we started. It tells you a lot of action, a lot of stuff going on, but not a lot of certainty about what comes next. You can definitely see that if we look from where we were when we did the show last week to today, it's about 156 basis point improvement. You might say, fantastic. I have no idea what that means. It means rates are about 0.3% better in the last week. And we just talked about, we had a fairly strong jobs report, a fairly disappointing CPI report, and a second tier report in PPI that was positive. So this is all about what's going on with the banking stuff there, Jeb. Threw a couple of charts in here, Jeb. We talked last week about how many mortgages, 90% under 5% and 70% under 4%, I think were the numbers. This breaks it down further. Look at how many people have a 2.875% interest rate. I mean, that's nuts. So looking at that, I would still love to see this data broken down by loan volume, the dollar amount of those loans, because I'm going to bet you that the majority of these 5% to 7% loans that are out there are really small loans that it's just not worth it for the borrower to pay the money to refinance. Last one here is really just consumer advice for you guys. Silicon Valley Bank, a lot of their customers were businesses. So they need to keep millions of dollars in one bank to hit payroll. You and I do not need to do this. So the big note that we want to take out of this is really hard to read this, but Silicon Valley Bank, 94% of their depositors had more than $250,000 there, meaning exceeding the FDIC insurance. Now, they're all going to be made whole based off of the emergency measures that they took this week. But this shows Citibank, 74%, JP Morgan, 52%. So again, a lot of businesses are depositors there. But if you have a significant amount of cash, make sure you move it around to a couple of institutions. Even if you have $1 million liquid, keep it in 4 different banks so you have all of that FDIC insurance in case this gets worse.
Hasn't the government set the precedent that they're going to back it regardless, Josh?
I wouldn't trust it. Yes, they have, but I still wouldn't trust it.
Nah, all good stuff. So, yeah, guys, a lot going on. So, Josh, if I were out there buying a house right now, I think this is the question that people really want to know. If I were buying a house out there right now with all the volatility in the market, bank collapses, rates moving up and down. I mean, you mentioned 3/8 in a week. I mean, hell, we saw 3/8 probably in a day on Monday just because of the volatility in the market. Would you lock today or would you float the rate today?
So I listened to 3 experts, and I truly mean that. They're all experts just before we came on the air here. And one is saying very cautiously float because of where we are above those statistically important support levels. The others were like, this is just a volatile market. We don't know what's going to happen. Yesterday was really bad for interest rates because it looked like the bank stuff was going to be okay. It had been 2 days since a bank failed, so everything was going to be okay. We come in this morning to another crazy day of volatility and improved rates because of Credit Suisse, and now it looks like that is going to be okay. I had another chart here that wasn't really relevant to what we're talking about that was showing that bank failures are generally clustered. In the last week, we had 2 of the 3 biggest bank failures of all time, and when you look at the rest of the top 30, they were all in clusters. It is likely that there is more trouble out there. I would say more likely than not. So do I believe rates are going to go lower based off of inflation moderating and more bank issues? I do, but who knows what happens from day to day. So if you're closing in the next 2 weeks, 30 days, I'd probably lock and get the hell out of the way.
Yeah, I mean, that's essentially like, I was reading again, someone that we both follow here before we go on the show or listening to a video, and he's basically saying that, the longer you go without another banking collapse, if you will, the likelihood of rates going higher is the probability of rates going higher is higher. The more volatility with regards to banking collapses and, wondering what different governments are going to do, how they're going to step in, what have you, that volatility is actually what's allowing interest rates to come lower at the moment. It has nothing to do with CPI, has nothing to do with the jobs report, has nothing to do with the fundamentals that we've been talking about for the last 6 months, if you will, year, if you will, when it comes to interest rates. So just be careful out there, guys. If you are in the, getting close to pulling the trigger on locking a rate or whatever, I would say be more cautious than risk averse, and just make sure you're making the best decision for you either way. But gambling in the market right now with all this volatility is a losing game, in my opinion. So, Josh, we've got some questions. We got some comments. T Loke says my joke fell flatter than Suge's record deal after Dre left.
T Loke is right.
Rickless Cage, terrible dad joke. All of these things are true. All of these things are true. But let's
start. It's been a bad day for you, Jeb. You also had a troll getting after you on the YouTube channel today.
Yeah. So if you guys don't know, there is a YouTube channel as well, that for the Educated Home Buyer podcast. So for those of you who listen on the podcast, you probably don't need it. For those of you who like video, it's a good place to go and get the same information. But every single Tuesday, we post a new episode where we deep dive into a topic specifically related to housing. We've done things on like the loan estimate, down payment, literally everything. We just recorded one today on mortgage insurance, everything you need to know about mortgage insurance, which we'll post next Tuesday. But this last week, we did a video on like what's actually happening in the housing market, what's going on here in SoCal, what I'm seeing, how that's affecting other things. If you're interested, go check it out. It's on the podcast. It's on YouTube. Both are good places to catch it. And this Friday, we'll take this episode that we're recording at the moment here on my channel and take the audio from that and put it on the podcast as well if you want to listen to it. So there's no video of that. That only shows up on the podcast. So go check that out. But Josh, there is a question here that came up earlier today. It's obviously in the news. And so something I want to address because we have a lot of people that are interested in FHA because it allows minimal down payment and lower credit scores and all the things that FHA allows. But heard FHA is going to offer 40-year mortgages in May. This almost guarantees there will be no crash and prices will skyrocket. So unfortunately, the headline doesn't give it the context that you need to understand. So Josh, when they say 40-year mortgages in May, what actually got passed?
They have authorized the option for extending a loan modification out to 40 years. You will not be able to go get a 40-year FHA mortgage. But if you get in trouble with an FHA mortgage and you go back to your servicer, HUD has authorized them to do modifications of up to 40 years to keep you in the home. So we've talked before, Jeb, a million reasons why 2008 is unlikely to ever recur again. Things like this are one of them. It doesn't mean home prices are going to stay or go to the moon or this prevents a housing crash. But one of the problems among many, one of the problems that we had during the last housing crash is that servicers and the holders of mortgages reacted irrationally. They said, go pound sand. You owe me the money. Give it back or give me the house. And they ended up owning blocks and blocks of houses that no one wanted. So the prices crashed far further than they needed to. So if we get to a situation, we showed the chart last week, distress is at record low levels. So very few people should be requesting or needing a modification. But this is an additional tool in the tool belt where if you're an investor and someone comes to you and says, hey, I can't make my payment, would you rather say, I will give you an extra 10 years to repay me? Or would you rather say, well, cool, pay me back less interest? I'm going to say, I'll give you 10 extra years and I won't get my money back as fast, but I'll actually make more over the long haul. It's a good tool. It is not going to change the market in the way that the commenter thinks it will.
Well, you actually brought up an interesting point earlier when we were recording the podcast for mortgage insurance. You brought up the point that Standard & Poor's says that the typical lender, the foreclosure cost for them to actually foreclose on a property is about 26% of the loan amount. So you think about that. Would a lender rather modify your loan, give you a couple extra years, modify your payment, give you a lower payment, and get some payments coming in, or spend 26% of that loan amount trying to foreclose and own a property that they're going to end up selling at a discount? Chances are they're going to modify that loan. So, but that's a whole different precedent that's been set. So we got a precedent from banks. We got a precedent from the Fed. There's a lot of backstops happening in the economy right now that don't bode well for things collapsing. But what do I know?
It creates problems in the long haul. It's not a good thing. So there's that concept of creative destruction. You let businesses fail. You let people who can't afford their home lose the home. But with all that being said, the concept in 2008 was there's moral hazard. If we go and we give these people, say, hey, you owe me 7.5% interest and I give you 2% interest and cut $100,000 off of your loan amount, well, that's going to teach everyone to not pay your mortgage or go back to your lender and request some sort of discount. Well, the reality is the alternative was much worse. So there's some validity to that concept of moral hazard, but at the same time, we were bailing out the richest people at the top of the market, but we weren't bailing out mom and pop and brother Sue and Aunt brother Joe and Aunt Sue and everyone on Main Street. So it'll be interesting to see going forward. I don't love bailouts, but I do like logic and loss mitigation. If you're going to take a loss, take as little a loss as possible.
All right, good stuff. Felipe says, my wife and I just drained our savings to close on a $1.04 million Las Vegas house this morning on a 90% loan at 6.25% interest. How worried should we be about being in a negative equity position? I wouldn't say you should be worried about being in a negative equity position. Is there a chance that you could end up in one? Sure. It's only a problem in the cases where you have to sell that property. If you're comfortable with the monthly payment, you know, and you see yourself being there for years, then who cares? At the end of the day, I mean, you also did put 10% down. So you being in a negative equity position is not likely at the moment, because even if prices drop 10%, you'd still be in the same position. You would still owe, you know, the same amount that your house is worth. So there's not negative equity there, but you could be risking the savings at that point. But again, it's not a problem unless you have to do something. So for those out there that could be sitting on negative equity positions, unless you have to sell, there's nothing to be concerned with.
Jim, we had a couple of follow-ups here that I actually like, and we can buzz through them pretty quick. T-Loke follows up with a good thought here. Although bank runs failure is common in clusters, the federal government has never responded to a large bank failure without taxpayer support or so fast. I say it's not a bad idea to be optimistic. Totally agree with you. You'd take as 100% correct. What we're saying is the fact that they saved the patient from dying of the heart attack doesn't change that the heart attack was there. If there's more banks that have been eating cheeseburgers and sitting on the couch, they're going to have heart attacks too. It's a sign of systemic issues, regardless of what the government does to prevent it. And it may also be the fact that the government was the one handing them the cheeseburgers and force feeding them and making the problem in the first place. So long way of saying it's a good point, totally valid that we're not going to see as much pain because the government is saying they're not going to let it happen, but it's still an issue and it's still signs of problems in the economy. The other follow-up here is Bren follows up with, how long do you have to be in your new home before refinancing? And then the follow-up, and can you get the 40-year plan when refinancing? Let's say as clear as possible, you cannot get a 40-year FHA mortgage. If you get your mortgage and you get into the house and you get
or
into
a conventional
trouble,
mortgage.
Or a conventional mortgage. You can on some non-QM loans. They are out there. They're going to have a higher interest rate, which mitigates the extended term. But on this, we answer almost every week. You don't have to be in your home for any period of time. When there's a net tangible benefit to you to refinance, you are able to go to a lender and refinance. On an FHA or conventional Fannie Freddie loan, you are not going to get a 40-year term.
All right, good stuff. Round Earth, how do you know how much your house is worth? Is Zillow accurate? I wouldn't say Zillow is accurate. It's a tool in the tool belt, if you will. So use it, but don't let it be the only source of where you gather information. I would say your best source of getting an idea of what your home is worth is checking with a real estate agent. Finding if you own a house, talk to the person who sold it to you, your agent, if you will, and ask them what it's worth. But, you know, if you're looking at these websites, the problem with them is that in markets, even like Southern California, where you have densely populated communities, suburbia, if you will, and a lot of tract homes that should, you know, lend its way to getting accurate information, it's still not that accurate because what happens is one house that is sold, even if it's a model match to another property, doesn't necessarily mean the property it's comparing it to is comparable. It can be different on the inside. The upgrades can be different. The location within the community can be different. One can be an interior location versus one backing to a major street. And it could be giving you, say, a false positive, if you will, or a false negative in the sense that it may be comparing your house to the house that sold that needed a lot of work on the inside and back to a major street. And therefore, it's reflecting a lower value than your home is worth. On the opposite side, it could be doing the same exact thing. So it's probably a little bit better gauge if you have a condo and there's a lot of condos that have sold in a building, that sort of thing. It's a better, you know, tool at that point, just because it's got more data to go off of when comparing it. But again, I would use Zillow. I would look at Redfin, but a lot of them are using the same algorithms to come up with it. So your best option is a real estate agent, a real estate professional that can answer the question for you. Josh, we've got.
I've been triggered. Can we answer one of these questions that just? And it's Nicolas Cage back with it's a good question. And I say it triggers me because this is one of the most deceptive bullshit things that lenders throw out there, especially a builder's lender. The only reason we had the question, well, here, let me ask the question. Closing on new construction next week, lender is giving me a free refi within the first 2 years. The caveat is that I have to wait 6 months after closing before I can take advantage. That's to their benefit, because if it pays off in the first 180 days, they're going to have to pay back everything they made on the first loan. Builders lenders are never competitive on pricing. They've been incredibly attractive for the last year because the builder themselves is subsidizing that lender losing money to do your loan. So there is no world in which you're ever going back to that lender for that refinance, because they will never be competitive on terms. So it's sort of, you guys have probably seen the rocket commercials that we have, the inflation protection. They're going to give you inflation buster. They're going to give you 1% back. Well, that's because they charge you 2% too much for the loan. And then the second piece is anytime in the next 3 years, if rates drop, we'll refinance you for free. Again, it's because they charge too much for your loan to begin with. So any and all of this, no one does anything for free. I will tell you, if I do your purchase and you come back, we're not looking to make a ton of money on you the second time, but we still have costs and overhead, and we still need to make a profit on every loan. Otherwise, we're blocking up the system for other loans. And we're no different than any other lender. No one's going to say, hey, we're so eager to get a loan right now, we're legitimately going to do a loan for free in 6, 12, 18 months. They're just saying, we're not going to charge you for it. It will be in the transaction in a higher interest rate somewhere else along the line, a higher interest rate relative to what you could get from other lenders. So ignore all of this stuff. Rates are likely to be lower in the future. You are likely to be able to refinance. You are not going to rocket, and you are not going back to the builder's lender for that refinance, because you will get better terms elsewhere.
There you go. A couple of questions regarding, well, that's not it. We can answer that question in a minute. Regarding Cal Haffa and their Dream for All loan assistance, loan sharing, whatever it's called, program. The first question is, how do I think it will affect the market? I mean, it might create some more buyer demand, just get more buyers out there that might have not been there otherwise being able to buy homes. So that could, it could stem some buyer demand. But one of the questions that I wanted to go to a moment ago was around the idea of this one. How long do you think Dream for All program will continue running before all the funds are gone? They have $500 million of funds.
That's a lot of money.
A lot of money, but they'll go as high as 181,000, I think, is the most that they'll lend on any particular property, just because of where the max loan amounts are. This is for California, guys. So if you're outside of California, you're probably like, what the hell is he talking about? It's a program through a Senate bill that was passed here in the state of California that will gift first-time home buyers up to 20% of the down payment. Got to be income restrictions. There's max loan amounts. There's different guidelines going on there. But 500 million is a lot of money. But I bet a lot of people will apply for it, and I bet it will go faster than most people think.
So Jeb, I just ran some basic numbers. So they'll go up to 180. Let's say it hits somewhere near the middle, like 120, 125,000. It's a little over 4,000 of them that they can do. Do you know how many homes are expected to sell in California this year? Nationwide, we're at like what?
450,000.
Okay, so 450,000.
I'm guessing. I'm guessing. That was a guess. I thought you had the answer. I thought you were.
No, I don't. So that's what I'm saying. What is 4,000 out of however many are going to be there? Cal HFA, there are reasons why it is not the best answer for most people. It's going to have an above market interest rate. You have to be okay with sharing your appreciation going forward. They're going to have a lower debt to income ratio, which is somewhat going to be mitigated by them making the larger down payment. You have no mortgage insurance. So it's an attractive program from what we know. We need to know more of the details, but Jeb, I'd probably be inclined, if they can only do about 4,000 of them, they'll probably run out of money fairly quickly.
I don't disagree with that, because I bet a lot of people will be applying for it. I think more people will not qualify for it than do. Well, that's obvious statement, but there will be a lot of people that bog down the system initially. But those that get through will get a nice opportunity to be able to buy a house and get the down payment. And it's a good deal. I just actually recorded the video today. It'll be posted sometime next week and go over some examples of how it works and all that good stuff. So if you're in California, stay tuned.
Jeb, a quick Googling says that CAR is expecting 360,000 sales. So
Okay,
4,000, we're close to 1% of all sales could use that program. So 99% of homes could sell without it, and they would still run out of money in a calendar year.
Okay, good stuff. Question here. This is a question that I've pondered myself with everything going on in the banking world at the moment. Will lending standards tightening? Oh my God, I'm going to start over. Will lending standards tighten with everything going on in the banking system, Josh? So with all of this craziness happening in the banking system, banks losing money, is that a recipe for conventional, for Fannie Freddie tightening guidelines to protect themselves in other ways?
What can we say with certainty? We can say it's not a recipe for loosening, for easier credit standards, right? So we don't see that happening. So the two options are things stay the same, status quo, or they get tighter. Why would they get tighter? They would get tighter if there was additional risk of losses to Fannie Freddie, FHA, VA, USDA, whoever's guaranteeing the loans. And what we're looking at, we are seeing a duration problem. Banks have tied up their money for a period of time with really low yields, and it's causing them liquidity issues in the short run. Go back to 2008. It was a quality problem. Now, U.S. Treasury is backed by the full faith and credit of the U.S. government. It's a promise from the biggest government in the world that has never not paid their debts back. So people will accept a very low yield because there's a very high probability of getting their money back. Second to that, mortgage-backed securities have always been considered to be probably your next best bet. And the reason being is they are asset-backed. Well, in 2008, the problems were the quality of those. Homes weren't worth what they were supposed to be. The credit quality wasn't what it was supposed to be. So in light of that and all of those losses, all of the lending standards had to tighten aggressively. This is a duration issue with what banks are holding in terms of assets. I don't anticipate that being a problem where they would have to tighten guidelines. Until we get into an issue where there is more supply and less demand and home prices start coming down, we don't have a recipe for tighter guidelines. But guidelines have been really tight for 15 years. They never got very loose. And I don't expect them to tighten, but I don't expect them to loosen either.
Yeah. Do we know if any of the banks that are, there was a list of like 30 banks, right, that could be potentially the next one to go? I looked at the list, without really really thinking too deep into it, but are any of these banks wholesale lenders that essentially could be affected in lending at the moment, Josh, that you're aware of?
Not to a large degree, and that's another difference between 2018 and today. The vast majority of loans are originated by non-bank lenders. So the two biggest lenders in the country, United Wholesale and Rocket Mortgage, they probably do, between the two of them, more than 50% of the loans in the country. They are not banks. The way their funding works is very different than a traditional bank. They're not taking deposits and lending off of it. They're really only a bank in name in that they make loans. So from that perspective, almost all of those names, Chase, Wells, Citi, they do mortgages, but it is not a significant portion of their business.
No, good stuff. All right. We got a lot of questions around the same topics here, guys, trying to find something a little bit different. I clicked on this one a moment ago, so I'm just going to click on it just so we can have the conversation. What is the lowest rate that you ever saw on a fixed rate, Josh?
We closed one at 1.875. It was a VA loan, so VA much lower than the market. And this guy rightfully said, I'm going to be here forever. I don't see rates going lower. And I think he paid close to 2 points to get that rate, but we got it under 2% on a 30-year fixed at the absolute best point in the market.
All right. That's a low rate, guys. That's free money. That's actually more than free money. If you have money in a bank account that's paying you 3-4% and your mortgage is only 2%, you're actually making out. Let's see here. Al has a good question. What happens to your home loan if it's a portfolio loan by a bank that becomes insolvent? I asked because I heard First Republic has many home loans with lower than market interest rates. So Josh, if my bank is with, just hypothetically, let's just say First Republic, and First Republic goes under, does my mortgage go away? Does it get transferred to another lender who ends up taking over? What happens?
Someone will take over the assets of that bank. Your mortgage is a liability to you. It is an asset to the holder of it. So yeah, they will liquidate all of the assets and you will not have any change in the underlying mortgage. Whoever takes over those assets will just service and collect the payments on those.
All right. Good stuff. Good stuff. Dom says, what's your over under percentage for Powell getting his way for job losses coming in the next 6 months to a year? So Powell getting his way. I think Powell wants unemployment to stay high. I mean, not stay low, rather, for unemployment not to rise, because essentially that means that they could come out of, all of the Fed hikes with a softer landing, if you will, no recession. If unemployment rises, that creates more of that hard landing scenario, recession being the primary issue with that whole thing. So what's the likelihood that happens? I think it's pretty high. Is it 6 months? Is it a year? I don't know, but I think it's toward the higher percentage, 70, 80% that you start to see unemployment go up here in the next 6 months or so. I don't know where it goes, how high it goes, 5% maybe. But with that said, I think a lot of people want to compare job losses to 2008. Josh, we've talked about this. Unemployment during that time was at what, 12%? Something crazy. Yeah. It was some absurd number. We're talking maybe push as high as 5% here, which will have an impact. There will be people affected that own homes, need to sell property. But I outside of that, I don't know what's going to happen here, because the Fed is really, they were between a rock and a hard place prior to all of this happening, because, they have debt that they have to service. They have inflation that they've got to control. Now they've got banking going, opposite of what they're trying to accomplish. It's hurting their ability to continue to hike rates. So I don't know. Would you want to be a Fed member, Josh?
Well, listen, this is all academic geekery, and no one can say for certain, but the Fed has run these numbers. Their belief is to get inflation back down to 2%, we need to lose 6 million jobs. And you go, 6 million jobs, oh my God, that's a ton. Gets us to an unemployment rate of 4.1, 4.2%. We're at 3.6 right now. So about 6 million jobs have to go if we're going to get to that 2% inflation. So do we get them by out and out cuts where jobs month over month, we're losing jobs? To lose that many jobs, you probably have to. So I'm of the opinion that the Fed would be perfectly happy with a 4.2% unemployment rate, as long as it means that we're getting closer. We're not even all the way to the 2%. They would, if you could just offer Powell a deal right now here, 4.2 million, 4.2% unemployment and 2.5% inflation tomorrow, would you take the deal? And you say, yep, good, done, sold. So are they doing things to cause that, to want that to happen? I don't necessarily think that is the sort of the impetus behind their actions, but that's the direction that we need to go. Although, we showed in the chart earlier today, Jeb, wage growth is back on trend, even though the unemployment rate is lower than what it was by a good bit then. So maybe they can have both. Maybe they can have sub 4% unemployment and 2% something inflation, but we're going to find out here in the next 12, 24 months.
We definitely are. Dina says, what is the main reason for sellers to put such a high price when they likely have equity and low rates? Greed, desperation, illogical. It's no one likes to think that their home is worth less than their neighbor's house, or that it's gone down in value. When you've seen your neighbor's house sell, or you think that your house is comparable to something in an area, you want to believe that you can get that price, even as the market shifts and changes. That's typical seller mentality. Part of it's emotional. Part of it is just, some people just think what they have is nicer than the person down the street, and therefore it demands a higher price. each person's a little bit different. Not everybody's the same, but at the end of the day, if someone thinks they're losing money, that affects them emotionally. Therefore, a lot of times they make irrational decisions, and that irrational decision can be pricing too high, doing things crazy, thinking their home is worth more than it is, or what have you. So I would say that's probably a lot of it. Sometimes it can be misguidance. Real estate agents saying, hey, your house is worth X, agents trying to win listings, if you will. 2, 3 agents go into a listing appointment. I wouldn't say this is true, but a lot of times the guy with the highest price, that's competent is a lot of times going to win that listing, because the seller, that's what they want to hear. That's in the seller's head. They want to hear the highest price. Now, if you're going in with that mentality as an agent, you're setting yourself up for disaster to start with, but a lot of people do it. So is it illogical? Irrational, I think, is probably the better word.
I'm going to say it's very rational. So what is the main reason for sellers to put such a high price when they have equity and low rates? What I want when I put a for sale sign in my yard is as much as the market will bear. If you will overpay by $200,000 for my house, I'm thrilled. And I don't think I'm unique among sellers. So there's an illogical component to it that if I put a crazy price that no one's going to pay, I am fighting against myself. Jeb, you had that awesome chart a month or two back saying that by overpricing your home, you are going to discount it more. So again, as a greedy seller in the current market, I want to price it as close to what I know for a fact it's going to sell for, that we could hopefully get 2, 3, 4, 5 offers and get everyone playing against each other to maximize my profit. How much equity I have in my house is irrelevant. If I have my own house free and clear, I still want as much money as possible for it. Although, Jeb,
you'd be surprised though.
Some people.
You'd be surprised. I talk to buyers throughout my career, and now because how readily available data is, people can see what somebody paid for a house, and they say, well, that seller paid that for the house. They shouldn't, I'm offering them a fair price. Like, no, that's not how it works. Just because that seller gained money and appreciation, has owned the property a long time and done well, doesn't necessarily mean you get a discount just because you think your deal should be accepted. But I will tell you, buyers out there are as irrational as sellers wanting a high price.
I would say they're more irrational. If you think that the seller cares or thinks that you should get a discount because they bought their home really cheap, that's nonsense. Like, if I got my house free, I still want to sell it to you for as much as possible. Are there people out there? I was going to say, Jeb, I met with a guy earlier today. He was saying his parents rented their house for like 20 years and rents were much cheaper than, paid $140,000 or $150,000 in rent over that time. Their landlord liked them so much, and he was getting older, that he credited all of their money to them towards the purchase of the home, and they paid like 60% of what it was worth. I was kind of blown away, but guy was legit. Is an honest guy. He wasn't making the story up. But there are people out there that for different reasons will give you a discount. But in general, if you and I are not blood related, if we're not kin, I'm not giving you a discount.
No, I mean, that's essentially like a rent to own, if you will. I mean, that's more or less how a lot of those are structured. So, let's see, Josh.
Well, if you can find me a rent to own with someone, a landlord that will contribute 100% of my rents to my purchase, I'm in. Tell me where to go. I'll be a renter. I'll be a renter.
Yeah. They normally don't give you 100% of your rents. It's normally a portion of your rents, just FYI, for anybody out there wondering how that whole thing works.
And technically, from a lending perspective, if you did do a rent to own or your landlord wanted to propose something, we're only allowed to credit the portion to you that exceeds market rent. So if market rents are $2,000 and you're paying $2,500, we can credit you the extra $500 a month. They can't just give it to you out of the kindness of their heart. It's an inducement to purchase.
There you go. All right. Here's a question that we kind of addressed today on the episode of the Educated Home Buyer where we talked about mortgage insurance, but this is put it a little different way. It says, if I want to purchase a home within the next 2 years, should I jump on it now or wait another 12 months or so? What are the chances prices are worse 12 months from now? So I guess the question is, wait and do what? Are you living at home with no rent, no payments at all? Or do you currently rent? Are you paying, a payment to someone somewhere at the moment? And when you mean by worse, are you saying rates higher, prices higher at that time? There's a lot going on in this question, Josh, and there's no easy way to answer it because each person's situation is a little bit different. But how we addressed it earlier, was, by waiting, essentially, what do you gain? What do you gain by waiting? Throwing it your way.
That I don't think there's a whole lot to gain, because we've talked about people. The big thing when rates started shooting up last year, every mortgage and real estate professional wanted to tell you, marry the house, date the rate. There's some truth to that. It still has to make sense. The numbers have to work for you. We've talked about it on the show. I believe that in the next 12 to 24 months, rates are going to be a good bit lower than where they are right now. They're not going back in that time frame to anywhere near. You know what, Jeb? I shouldn't say that, because they're not going to go back anywhere near where they were. The events of the last week have told me to never say never. Anything could happen, and we could see that happen. Highly unlikely, but I do think we're going to see rates somewhere between 5% and 4% in the next 12 to 24 months. So if you buy today, what advantage does that give you? Now you can refinance and take a benefit of that lower interest rate, unless home values drop. And I will tell you that if interest rates drop from 6%-ish, over 6% right now, to 5%, 4.5%, home prices are not going to drop. So if you believe rates are going to move lower, if you believe the economy is going to remain relatively solid, that we're not going above 5% unemployment, I don't have a recipe for home prices dropping. I definitely don't have a recipe for rapid price appreciation. So if you choose to wait 2 years, I don't think you're going to be on the wrong side of it, and the price is going to be a ton higher. But, Jeb, we ran a number earlier today. We always talk about, or often talk about, the 70-year average nationwide is about 4.7, 4.8% annual appreciation. I don't think you're likely to get that over the next 5 years. I also don't think you're likely to get depreciation. So are we looking at 2%, 3%? Let's say it's 2% and you wait 2 years. That's more than 4% more you're going to pay for the home, especially if I'm right and rates do improve, where we would more likely see maybe 3.5%, 4% appreciation. Again, not a recipe for massive appreciation where you're going to be on the wrong side of prices. So you have the time to make the right decision for you. But if you get in now, you're paying principal down on the payment every month. You're likely to get some appreciation. Know your area, because there are areas where that is not true. Know your area, work with an expert realtor. And on the loan side, you should be able to take benefit of the interest rates dropping over the next 12 to 24 months.
Yeah. I mean, if your rent's $3,000 a month, I mean, you're paying $72,000 over the course of 2 years. That's a lot of money. Would you be rather pay it towards your own property or paying someone else's? I mean, and I know it's not that simple, but that's the big idea, is that, the sooner you can get in with a payment that you're comfortable with, the sooner you can start benefiting from home ownership, and reaping the rewards of why homeowners have a 40 times greater net worth than those of renters. But Josh,
one last thought there, Jeb. You
Yep.
said this a while back. It's not timing the market, it's time in the market. So if you are comfortable and your life is ready to buy, those 2 years in the market are valuable to you. That doesn't mean, hey, throw caution to the wind and jump in. But if it's right for you, the time in the market will be helpful.
All right, good stuff. Kyle has a question here that we often come across, and it says, I'm a 1099 worker, deduct so much that my income is tiny. My wife has no income, and I have a friend who said he will co-sign for me. Will it only be my friend and I on the loan?
If it were up to me, I would never put a borrower on a loan that doesn't have income. And the reason being is they are liable for that loan, and they're not adding any strength to it. Like, super simple. Jeb's wife stays home and works by taking care of the kids. We don't have any qualifying income. I would put Jeb on the loan and not have his wife be responsible for that loan and have potential liability if Jeb goes crazy and goes on a bender to Vegas and takes out a home equity line and loses it all on blackjack. There's reasons for it. There's benefits, and it sounds like a lot of fun. Invite me if you do it. I will tell your wife I wasn't there. But bigger picture, they're not bringing any strength to it. There's no benefit to having them on that, but they can absolutely be an owner. In that same situation, Jeb's wife is not going to be like, yeah, just let Jeb own the house. I'll deed off of it. You can be a title only borrower. You're not a borrower. You're not liable before the loan, but you can be on title as an owner. So in this situation, you would absolutely want your wife on there. This sounds crazy. Your buddy, I wouldn't recommend it, but he could co-sign for you and not be an owner. You can be a co-borrower and not be on title. You're obligated for the loan and you have no rights in the property. So it's great risk to you. Don't do it. I have seen parents do it for children. I haven't seen buddies do it for their friends.
Yeah, don't do that. If you're going on a mortgage, be on title. That way, if something goes sideways, you have some say in the deal. With that,
and I've seen them go sideways, Jeb. I've seen.
Oh, I'm sure you have.
It
probably happens more often than people want to admit. But yeah, you need to have your name on title so that you can again be there when the chips fall to actually do something if necessary. So we're an hour in. I want to take this time to say thank you guys. Thank you to those of you who show up every week, those of you who are new here asking questions. As you can see, a lot of questions come through here. We do our best to get to them. But if you find any value at all tonight, do me a favor, hit the thumbs up. If you're not subscribed to the channel, feel free to subscribe to the channel to stay updated on everything real estate related. If you like podcasts, go check out the Educated Homebuyer podcast. It's on every platform out there that you would listen to podcasts. There's also a YouTube channel that you can check out as well, where we actually have the videos from those. The newer videos are actually much better than the older ones that we filmed a year ago. But nevertheless, all the content
was good. The video was not as good.
All the content is there. So with that, I appreciate you guys showing up every week and continuing to support. Christian. Yeah, were you going to say something, Josh?
I was. I'm going to make a plea again. Our channel is only 12.1% female in the audience. So all of you females over here asking great questions, I would love for you to go out there and be educated home buyers so I don't have to look at this giant blue bar when I'm looking at our demographics.
We appreciate you all. You don't need just females. We need everybody.
Listen, I'm looking for balance. All of our audiences are more than 50% male, and I happen to know that genetically half are female.
Fair enough. Christian says, if I'm broke, would it be wise to pull out of a 401k for down payment of a property? Now, with that comment came a lot of people in the comments talking about having pulled money out of 401ks. People saying, I was able to pull money out and I'm paying myself back at an interest rate of 8.5%. So I'm okay with it, so on and so forth. So Josh, if you're broke and you're pulling money out, this is a little bit different premise, but let's talk about both. Let's talk about being broke and pulling the money out and the case that maybe you're not broke and you just want to borrow some money for a down payment. What are your thoughts?
So specific to this question, I do not like the first part and the last part going together. If you are broke, you should not be buying a property. In very rare instances, are you able to own for less than it costs to rent? So if you are unable to save as a renter and you're taking a higher payment as an owner, we talk about this all the time on the show. We want everyone to own a home. We think it's the right decision over a lifetime. But what are the reasons that we're broke and don't have? And I'm sure you're saying it jokingly. You're not saying, hey, I'm broke and I spend every nickel I have and I'm at the strip club every night. You're saying I haven't been able to come up with a significant.
What just happened?
I'm just saying.
We went from being broke to being at the strip club.
I'm not accusing him of that. I'm telling him I'm confident that he does not do that. So if you're just saying, hey, I'm having a hell of a time coming up with a down payment, now that goes to Jeb's bigger question. Typical buyer having a hard time coming up with a down, or you don't want to use all your savings that's liquid. A 401k loan is a great resource for coming up with a down payment. You're going to repay yourself with interest, so you're not losing out on anything, but you're getting benefit of those funds to become a homeowner. Someone had mentioned earlier, and maybe your follow-up was that you were just going to take the money out. Do not take the money out. You're going to pay a 10% penalty. You're going to pay income taxes on it. So you take a big chunk and you end up with a little chunk. So take the loan, pay yourself back over the long haul, which really, what do we talk about here, Jeb? Everything is long haul. This isn't get rich quick. It's get rich slow. Keep contributing to your 401k, borrow from yourself, pay yourself back, become a homeowner, make your payments on time, refinance when rates go down. Don't take cash out. Arrive at retirement with a nice chunk in your 401k and a bunch of equity, hopefully all of the equity and no mortgage. Like, what did we say, Jeb? 36% of homeowners now have no mortgage. We want you to become
50,
one of those.
It was like almost 50%. Yeah, it was
a number.
It was a lot. Mr. Do It.
Didu.
Mr. Didu It. What do you think about adjustable rate mortgages in this environment, Josh? So do you have a problem with an ARM loan?
Well, let's look at the inverted yield curve, and it will tell you that it's probably not in your best interest. In general, before it starts to make sense, I want in excess of a 0.5% discount if you're going from a 30-year to, say, a 10 or a 7-year. I'm not against the product. Most people are not in a home and in a mortgage for long enough for it to be problematic for them. And we generally, in a 7-10 year window, have two refinance opportunities. So I'm not against them. But when you have an inverted yield curve, mortgages, we generally say, are tied to the 10-year treasury. They closely follow the 10-year treasury. But when we have a period of a lot of volatility like we have right now, they tend to follow shorter term treasuries. So shorter term treasuries, 3-year, 2-year, 3-year, 5-year, 7-year, they're inverted. They're actually yielding more than what the 10-year treasury is. So when you look at a loan like a hybrid ARM that's going to be tied to a shorter duration treasury or track more closely a shorter duration treasury, it's not going to give you the discount that you want. Now, if you see it, if you're out there and you're talking to someone and they say, hey, I can give you a 6.25 30-year fixed, or I can give you a 5% 7-year ARM, I'd be all ears. I would want to listen to it. I would want to hear what your thoughts are on how long you're going to be in the property, what your income trajectory is through that time, what's going to be the same in 7 to 10 years, what's going to change. So I'm not against the product at all. Not doing very many of them, if any. We did a few last year when we didn't quite have the yield curve inversion, and you could get people discounts that made sense.
All right, good stuff. I got a question from Trisha saying, I've been pre-approved for $200K. Recently, I was just inherited a house valued at $150,000. Should I buy now or wait for potential more house? So I'm confused by the question, Josh, because I feel like they inherited a house, they have a house. So do you
imagine that she's in Florida and she inherited a house in Tennessee. That doesn't do you a heck of a lot of good, other than now you have a potential rental property. So Trisha, I've been wanting to get back to this one. Hopefully you're still here and you can give us some follow-up and some clarity. Yeah. A couple of things here. If it is a property you're not going to live in and you can convert it to a rental, you can start using that rental income. Maybe that bumps you up to qualify for more. You could move into that property, not have to buy a property at all. You could borrow against that property $50,000, $75,000 and make a 20% down payment on a $300,000 house versus whatever you were thinking. So as a mortgage planner, those are the questions that I'm going to ask you. We're going to look at all the assets, and now that property and the equity in that property is an asset. Doesn't necessarily mean we're going to borrow from it, but I would love to see you keep it and get into another home. And if we can leverage it a little bit to get you to a $250,000, $300,000 home, if that's where you need to be, then over the long haul, it's going to be a positive for you.
There you go. Salita says, housing questions totally off all subjects I've heard you talk about. What should a new home buyer do in the due diligence period? So due diligence period, I'm assuming we're talking about, you're in the first 15, 17 days of your contract, the contingency period, that due diligence time frame. You're going to do all the things that you need to do to confirm that's the house that you want to buy. You're going to do inspections on the property. You're going to make sure your loan gets approved. You're going to have your appraisal completed. But more importantly, it's you checking out that property, because all of the other things are kind of done without you doing them. Your loan being approved, the appraisal, all of that stuff. Everything else is taken care of, except for, things like home inspections. That's something that you definitely want to do. And it might be more than a home inspection. It might be a sewer line inspection, a mold inspection, a termite inspection if you're here in California, or, a geo inspection if it sits on the cliff. There are homes here in California, in Orange County at the moment, that have structural issues due to all the rain that we've received over the last couple of months, more so in the last couple of weeks, that have really impacted these problems. If you sit on one of these cliffs, you're going to, when you're buying a home, get some sort of geo inspection just to make sure that the house is sound and that there's no structural issues. So that's the time period to do it. In addition to that, you're doing things like measurements in the property, making sure furniture is going to fit, making sure, whatever it is that you want to do with that house, if you're having upgrades done, contractors come in, that's the time to get all of this stuff done, because typically speaking, you've got that time, that period of time within your contract allotted for that. After that time period is up, you essentially don't have access to the property per the contract, at least here in the state of California. Now, more often than not, sellers will allow you to come in after the fact and do some of these things. But a lot of it's better to get done during that due diligence period if you can. Second part of that question is, what's the first thing a person should do to the house? That's going to vary by person. So the very first thing, get the locks changed. I mean, that's the simple one, right? Get the house rekeyed.
I like that. That's smart.
I mean,
and Jeb, shockingly, would you say 70-80% of people don't? They just move in.
oh,
like,
for
"Yeah, I have
sure.
no idea who
Absolutely.
has keys."
Yeah, no, absolutely. Get the locks rekeyed is probably the first thing I would do. And depending on what you've done during that due diligence period might change how you do the next couple of things. But if you're looking to do upgrades and that sort of thing, you start getting people out. But yeah, I don't know that there's a right or wrong thing to do after moving into a property. It's your home. Enjoy it. That would be the second thing, right? Get the house rekeyed and then enjoy your new house. That would be it.
Jeb,
All right. Yep.
I want to congratulate our audience. Like, I just been rolling through while you were answering that mainly real estate question, and there's a lot of really good questions here. So we have, Jeb, an excellent idea for one of our next podcast episodes. Eileen says, do you have an episode on how to shop for a realtor? I recently listened to the episode on how to shop for lenders. I'm interested in what sort of questions I should ask a potential realtor. So Jeb, now without going with, we just shopping for a lender, shopping for a rate. So without giving away what we're going to talk about when we record that episode, what are a few bullet points for her?
Find somebody with experience, find someone that's competent, that understands the market beyond what a headline is. Can talk about some of the things that Josh and I talk about at the beginning of the show, where inventory is, where demand is, what's driving the current market in your area. They don't need to be able to tell you what home prices are going to do percentage wise or anything crazy like that. They just need to be competent, but experience is also a plus. And make sure you're working, whoever the person that you're hiring to help you is the person that you're getting. You have a lot of big teams out there operating at the moment, that you hire a face, if you will. That's the person that you initially talk to, and then you end up with somebody that is not that person. So those are some of the big things that I would focus on, but we'll definitely dive into that in an episode in more detail. Josh, we need to add that to the list.
Like it.
Raul's asking, will the new Brightline Bullet-ish train from Rancho to Vegas improve home values in the cities with stops? Is that approved? Is that thing I know it was in talks
started
again.
on it. No, so they're saying they're going to do it, but here's the issue. We have a giant budget deficit again in California. Shock of all shocks. Our governor told us that we were going to just be the greatest example of fiscal prudence and
because he gave away money, dude.
Forever.
He gave me money for doing nothing.
And they still want to give away. They got 14,000 plans for giving away money. They just haven't figured out how to get any to come in. So I was looking the little that they've done 20%. They've done a portion of about 20% of this project, and they are, I believe, over budget of what the entire budget was for the project. They said they would need more than $385 billion to complete this project. So here's the deal. I don't think there's any world in which this project is ever completed, but I'll humor you guys and say, what if the premise is true that our state government starts finding gold bars squirreled away somewhere and funds this, and they actually get it done sometime in our lifetime? It absolutely would have large positive impacts on anything along that route. You could get a job in Vegas. You could commute out to Vegas a couple times a week if you wanted to for business. Any number of things that are good with that. Like, Jeb, the best example that I fall back on is when they announced they were building SoFi in Inglewood. Everyone said, hey, you got to buy in Inglewood. Inglewood's going through the roof. And I'm like, you people are crazy. Inglewood's fine, but it's nothing fancy. People don't care about the stadium. Jeb, what's happened to Inglewood the last 5 years?
It's gone bananas.
And yeah. I think this train is much more valuable than a stadium.
Oh, agreed. 1,000%. Yeah. So, yeah. But I mean, again, the idea of buying now with the hopes that thing's going to be done anytime soon, not going to happen. Again, if it does happen, it's a long ways off. Just so we have a little backup when I talk about here in Orange County, our market still being a little bananas. We got Phil coming in saying Orange County is still a hot market. Sold a 1-bedroom condo for $435 cash, $15K over asking, in Fountain Valley, closed yesterday. So for those of you who don't know, Fountain Valley is about 5 minutes from where I'm sitting currently, even less than that. But yeah, so again, 435 is at the lower end of what's available here in Orange County. In fact, I just did a housing affordability a housing affordability video for another channel that I'm creating. And I think that the least expensive property in our market at all was $470 something thousand, and it was a studio with 700 square feet. So
when I saw that, I thought Phil might have the most affordable home in our market, even at a 1-bedroom. I was like, 435. Yeah.
Matthew Smith says, how much lower are VA rates than conventional, Josh?
For those of you playing along at home, Jeb's actual name is Matthew. So this is him just queuing us up with questions of his own. Matthew Jeb Smith, and then we have the Matthew Smith. Generally, we say government loans are about 0.5% cheaper. Right now, it may be a little bit more than that, 0.625, but you can count on them over time being about 0.5% lower than conventional Fannie Mae, Freddie Mac mortgages. And the reason for that, historically, they've always been more expensive. People felt as though with zero down, there's more risk. With FHA 3.5% down, there's more risk. They're sold into different pools. And prior to the meltdown, they were always a little bit higher than conventional rates. And since that time, people have realized, hey, Fannie and Freddie have an implied government backing. FHA, VA, USDA have true government guarantees. So for that reason, they've yielded, the Ginnie Mae bonds have had lower yields, and we've had better rates for those since then.
All right. ZL coming in with a couple of really good questions. First one is, what's more valuable, an extra room or a garage? I think to each his own with this sort of thing. Now, on paper, I honestly don't know the answer to that. I would lean to say that a bedroom is more valuable than a garage. But for some people buying a home, people need the garage, want the garage. So I don't know the answer to that. Josh, do you know a factual answer on that?
I don't. And Jeb, we have this question. I looked at buying that off-market property that you had, and we looked at the garage and we said, that would actually make a pretty nice ADU. And you look at it going, what does someone want? Do they want that garage, or would they rather have more space? And I think it is highly individual and likely to be like 50-50. There's definitely people that value that extra space, but there's also people like, bro, where's my garage?
Well, yeah. And I think that's what it does is I often, in speaking with, people that own property, say sellers and or potential home buyers and buying property, and talking about, potential resale down the road, things like this, like having an extra bedroom opens your pool of potential buyers to a higher amount, right? You got more people that are likely interested in a 3-bedroom versus a 2-bedroom. That's just the way that it works. More people interested in a 2-bedroom than a 1-bedroom. But at the same time, you got people more interested in having a garage than not having a garage. So it's kind of a catch-22. If you gave me the option, hey, Jeb, would you rather have a 3-bedroom with a garage or a 4-bedroom with no garage? I would take the 3-bedroom with the garage. But if you asked the same question, said, hey, would you rather have a 2-bedroom with no garage, 2-bedroom with a garage, 2-bedroom with a garage, or a 3-bedroom with no garage, I would probably choose the 3-bedroom with no garage, just because it's, you need at least that 3rd bedroom. So to each his own. Don't have an answer for you, but this is a really good question. Same person says, we've never had a situation like COVID that showered wealth to all of the investors and corporations. Is it plausible to think that home prices aren't going to go down too far? I think that's exactly what we've been saying for 2 years now. And it's not only the money that they've showered, it's where they've taken rates and what they've allowed people to do with low interest rates and the lack of supply that's now on the market that's essentially keeping prices high, in addition to people having those super low rates.
I look at it, and Jeb say showered wealth to all the investors and corporations. I look at showering wealth on all homeowners in the form of equity went up, but equity could go away. That doesn't necessarily protect you from trouble, but we saw the chart tonight. Everyone has a really low interest rate. They have more spendable cash every month in perpetuity going forward because they have a much lower interest rate than what they had before. So for a million different reasons, there's 100% truth to this story, that it is a lot of what happened is what insulates us and protects us from the likelihood of large scale depreciation.
All right. We got a question around down payment assistance. Says, do most down payment assistance lenders approve you for assistance first or after you start searching for a home, Josh?
Well, let's talk about down payment assistance. Most of the programs, you do not borrow directly from them. You go through an approved lender. Many of them only work with direct lenders. We talk a lot about working with brokers on this show. A lot of these programs will only go through direct lenders. Some of them work with brokers. The terms on down payment assistance loans are generally fixed, no matter who you go to. Like for us in California, the California Housing Finance Authority or agency dictates the terms of those loans. It's going to be the same no matter who you go to. But with that, you want to make sure that you deal with a lender that is aware of all of the options, can walk you through the pros and cons of them, and then is able to do the programs. What you find a lot is that someone either doesn't know them, isn't aware of them, or just tells you, oh, they're all terrible ideas. For us in California, the primary option is Cal HFA, and we'll show someone a side-by-side. There are pros to it. I mean, it's not free money. They're giving you money for your down payment and closing costs, but you will repay it. We want to go through, and again, numbers never lie, show you side by side what both of them look like and what benefits you might be gaining. So in terms of a lender that you're looking at, you want to make sure that it's someone that is aware of the programs in your state. Some states have lots of programs. You know, we do a few loans, our company does in Texas, and Texas has a lot more programs than we have. A big, giant state. Some of them are only in certain counties, certain cities. So if you're thinking that is the route that you want to go, you want to work with someone that is experienced and familiar with them. For us here in California, that California Housing Finance Agency, they keep a list of the people who are doing the most of those loans. I would say I can absolutely do one for you, but you might be better off with someone that does 30 of them a year versus someone that does 1 or 2 a year.
There you go. This is a good question here from Miss Crazy. Says, if people who bought during the 2 to 3% days don't want to sell because of higher interest rates, will they ever? I mean, I doubt we will ever see rates that low again. So inventory will never recover, question mark. So never like speaking in absolutes, saying never, but it is a problem. A lot of people have low interest rates, and the cost to move to another property, because you're likely paying more than they paid for that house when they got that 2%, 3% interest rate and or refinance. Equity has been gained since that point. So the cost to move is a lot more, is a lot higher. So what makes those people move? That is the question that we all want to know. Now, I will say that some people will move for one reason or another. They move out of state. They, change in lifestyle, change in, something in their life that makes them need to sell that property and or buy something else. The smart people will keep that property at 3% or 2% or whatever it is and buy another one without having to worry about that. But a lot of people will end up selling. Now, I don't know what causes that. What could help it is more inventory coming to the market and interest rates moving back down to a more reasonable level. Reasonable to me being somewhere in the 4% range, 4 to 5%, I think could stem some of these potential sellers to put their homes on the market and allow them to now purchase the new property at a lower interest rate, higher than what they had before, but it gets the market moving a little bit. The problem with that, and I've talked to Josh about it before, is that when you're a homeowner or have been a homeowner, most people don't sell a house that they've owned for a long period of time and then decide to become a renter long term. Typically, if they're renting, it's a short-term thing. So if they're selling a house, they're also likely buying a house, which is a one-for-one exchange. So that doesn't really add any new inventory to the market. It could free up some inventory for first-time home buyers and lower, price ranges to come to the market, but it doesn't solve the bigger problem, which is 6.5 million homes short for the population needs. So your guess is as good as mine. And I would love somebody to come out with a, something that a white paper, if you will, that kind of detailed how it could be solved, but I don't see a world in which it could. I mean, Josh, we've talked about maybe tax incentives, something that the government could do to help out. They could also make it more difficult for investors to hold on to property. I don't agree with doing that. I believe in capitalism. I believe in free markets, and good or bad, whether you agree with that or not, it allows the market to dictate prices. And the problem is the issue is so big and we're so far down the rabbit hole at this point, it's hard to come back.
I don't think anyone, Jeb, you talk about unintended consequences. I don't think this ever crossed anyone's minds that when rates went that low and so many people were buying or refinancing at those rates, that we were locking people into those homes if they didn't have the opportunity to buy at similar rates in the future. I know I never thought about it until last year when we saw rates spike up, that like, why would someone give up a 275, a 2875? We saw the biggest proportion of loans from 0 to 7% is at 2.875. Why would you give up a 2.875 for a 6% interest rate, or a 5% for that matter?
No, agreed. Let's see what we have here. So, Josh, thoughts on, so the question is, do you see 20-year fixed rates as cheap as 15-year fixed rates? Like watching my credit unions, rate sheet, blah, blah, blah. So do you ever see 20 and 15s being the same?
Most lenders price them identically to a 30-year. So 360, 300, 240, those are all priced similarly. Some lenders will give you a small discount for a 20-year. So if you're seeing your credit union is giving you that same interest rate as a 15 for a 20, I like it. The reason being is I got to go back and look at the numbers, because for so long we were used to looking at 3.5% to 4.5% numbers. We would say you're looking at, a 50% increase in the payment to go from a 30-year to a 15-year, but it's only about half of that to go from a 30 to a 20, yet you're still getting a 10-year decrease in the term of the loan. So run your numbers, but if you can get the same rate on a 20 as a 15, which is generally about 0.5% better than a 30-year fixed, I love the idea of going that route.
Good stuff. Salitha has another question about inspection. Says, I'm in California, LA County. Is a termite inspection different from a regular inspection? It is. The home inspector might go through the house and point out some areas of deteriorated wood, but more than likely that inspector is going to recommend a termite inspector come out in that report, because most of these guys aren't qualified to say whether or not that is in fact termite damage. So you'd get a termite inspector to come out, and most of these termite inspectors will do inspections free of charge. And if they do charge anything, it's like $100 or something. It's relatively inexpensive. And if you end up doing the work with them, then the report's actually free. So, but to answer the question, it's a separate report in most cases. Burns Mart says, will replacing an AC furnace combo with new ducts and water heater add value to a home trying to remove escrow? So I'm not sure the trying to remove escrow part, but will replacing these things help the value of the home? Yeah, but probably not to the extent that you want to think. I mean, if you add a $10,000, $12,000 AC furnace combo, is it going to add $10,000, $12,000 to your house? Maybe. It really depends on the buyer and what they see in the value of that. I don't know what an appraiser would value those items at. I would say it adds value, but it's not going to be substantial in most cases. I'm kind of second guessing what I'm saying here just a little bit. What it will do, as I mentioned a moment ago, is it'll add a larger pool of buyers who probably are interested in that property because it has those things. More likely to put an offer in at a higher price because those items are newer. If you have two properties that are identical, one has an AC, one doesn't, probably with the AC, assuming it's priced correctly, is going to probably get more bids. But is it going to be a significantly higher value because it has an AC? I would say probably not. But Josh, what are your thoughts?
It will definitely be helpful. There's no way it's a negative.
It's not a negative, but I just don't know if it's.
I don't think anything is going to get you dollar for dollar, but I do think, what are you replacing? Is it a 1960s furnace that no one believes it's going to last another year? Then it's going to have a bigger impact than if you're replacing a 1999 furnace that seems to be working just fine. It's not something that people generally look at and go, oh, look at my awesome new furnace. This is why I bought this house. But it is an element that people will take into account, and newer is better than older. And other things being equal, if you're looking at two similar properties, they would absolutely go for the one with the newer amenities or pay more for it.
Yeah. I mean, I think if you added a $10,000 furnace, air conditioning to a house, side by side, and you said, hey, I want this much more for my property because it has this, I think you could get dollar for dollar in that, providing receipts and saying, hey, listen, you can finance essentially the cost of doing this now because, it's already here. But is it going to add 25, 30? Like, no, I don't think so. But different markets are different. So it might be a little bit different in areas where it gets super hot and you need 2 to 3 air conditionings. Like that sort of thing's a little bit different. Here in California, a lot of properties are single level, have one AC, or one condenser rather, one furnace unit. So yeah, anyway, went way down the rabbit hole on that.
Jeb,
Josh,
we've got a good question here, and I just like saying his name, so I'm going to answer it. Josue has a good question here. Someone mentioned you need to show equity with one specific loan program to refinance. Which was it? It's not one loan program. It's generally all of them, except for VA and FHA. Both have streamlined refinances where you don't need an appraisal. You don't need to show that you have equity in the home. The government looks at those and says, we're on the hook for the loan now. If we can improve the borrower's situation, lower their monthly payment, we'll be happy to be on the hook and guarantee the new loan regardless of the equity position. Fannie Mae, Freddie Mac, conventional loans, jumbo loans, you're going to need to have equity to be able to qualify to refinance those. An important thing to note and remember is in 2008, by 2010, we had the Home Affordable Refinance Program where even Fannie Freddie loans could be refinanced if you were upside down. If we get to that point, our government has shown they love lending a helping hand. So I would expect that to be the case again, but I wouldn't count on it.
Yeah, good stuff. Burn says, I'm in the high desert, so AC heat are needed. Yeah, I would say maybe it adds some value, more so than being in a coastal community, but I just don't know to what extent.
Jeb, let's stick on the refinance front here. We're actually, so again, to reference back to the podcast, one of the things on the whiteboard that's going to come in the next 2-3 weeks is a full episode on refinancing. There aren't very many refinances going on right now, but we still get a lot of questions. So we want to give you guys a big overview of what that looks like when it makes sense. This is one of the big questions. For a person planning to stay in their home for 7 to 10 years, at what percentage drop to the current rate should one consider refinancing? Really, we've gone through this a lot. Simple rule of thumb, take $125,000, divide it by your loan amount, and it tells you how much you need to save to be able to justify doing that refinance. So if you have a $500,000 loan, 125,000 divided by 500,000 tells us we need to save 0.25%. Now, if you're somewhere in the country that's more affordable, or you've been in your home a long time and you owe $125,000, now 125,000 divided by 125,000, we got to save a full percent before it makes sense. Kind of goes back to when we were looking at the chart. I think most of those people with 5.5%, 6.5%, 7% interest rates that are historical and aged and been out there, they're out there because they have a $40,000 or $50,000 loan balance, and it doesn't make sense to refinance those. So varies with your loan size. The larger the loan, the smaller a movement you need to make it make sense for you.
All right. Josue has another question. I like how I did that, Josh. How accurate would you say is a Zestimate? True to value? Obviously, one may find more value than others. So I answered this question in the first part of tonight's episode, first half, first 30 minutes or so. So do me a favor, go check it out there. I basically, in summary, it's a tool in the tool belt. Don't go off it as the gospel. Does it make sense to purchase a rate buy down as a buyer? I understand that this is normally offered by sellers or lenders, but can you purchase a buy down as a buyer, Josh?
Many lenders will not allow you to do it, and I've not got a great answer as to why that is. I'm sure there are lenders out there that can facilitate and accept a borrower paid buy down. For me, I wouldn't do it because we talk about a 2-1 buy down where it's 2% lower for 1 year, 1% lower for the second year, and then goes to the note rate for the remaining 28 years. All you're doing is setting up an account to subsidize that lower payment. I don't want to tie up my money in an impound account that I can't get my money back, that is allocated to one and only one thing. What if you get sick tomorrow? What if you lose your job? Wouldn't you rather have that 2%? Buying a $500,000 house, we're talking about, or getting a $500,000 loan, we're talking about $10,000. I would rather have that money available. Put it in your checking account and use it to subsidize the payment for the next 2 years, if that's what you want to do. I wouldn't worry about doing the buy down through a lender, because all you're doing is tying up your cash.
All right, Josh. Kim says, if you win the lottery or from gambling winnings, can you use those funds for your down payment? So, Josh, did we talk about this specifically in our educated home buyer? We didn't talk about gambling winnings.
I don't believe we've talked
or lottery winnings.
I don't believe we've talked about gambling winnings.
We missed a piece here. So let's answer it now.
Absolutely a valid source of money, income, assets. So everything just has to be sourced. We have to show where it came from. The lender primarily wants to know when there is a large amount of cash showing up that there's not a debt tied to it, that you didn't borrow the money from some source. So if you win the lottery now and you come to me in 3 months to get a loan, that money is going to have been sitting in your bank, and it just looks like you've always had $1 million, $10 million, $50 million sitting in the bank. But I suppose if you had $50 million, you probably wouldn't need a loan from me, right?
There you go. Probably not. Maybe it's a small lottery. Maybe it's just
A scratcher.
I mean, one of the lottery winners, I just saw a headline again. Headline, didn't read the article, so I don't know all the details, whether it's even true. Just bought that $25 million house in LA. The $2 billion winner bought a $25 million house in LA. So it's possible. You might not even need a loan. You just buy it cash. Maddie's here saying happy Wednesday. So happy Wednesday to you. Josh, is there an average cost of a buy down? It's what, 1% gets you a quarter on the rate? Is that fair?
So a permanent buy down, that's what it typically is. But we got to look at the rate sheet and see what lenders are charging. Sometimes it's more, sometimes it's less, but that is your rule of thumb. And if we're talking about a temporary buy down, it varies with what the note rate is. And if we're doing 3-2-1, 2-1, or 1-0 buy down, so there's just a calculator that you plug it in. If you look up buy down calculator online, you can see the cost by note rate and loan term. But in terms of what does it cost to permanently buy it down, you just got to look at the rate sheet every day. So talk to your lender.
All right, good stuff. Raul says, would you take on a listing that's out of your normal scope, say $10+ million home? Would I take it on? Absolutely. I know and have access to a lot of top agents here in Orange County that sell homes a lot more expensive than that I could call friends, that I could lean on to get more information and/or to co-list if I didn't have the information necessary. So if you're selling, Raul, a $10 million house, I'm your guy, man. Reach out. But no, in all reality, that's yeah, absolutely. Why not?
What if it's in Kinston? What if it's in Kinston? You might not be licensed there.
There actually was a $6 million house there at one time. I don't know if it was the biggest house in North Carolina. I forget how many square feet it was, but it was 16 bathrooms. You should see this thing. I'll pull up. We'll have to pull up a picture of it. I'll show it to you. It's insane. Would you recommend buying a new construction with unfinished basement to save money? Here in California, we don't have basements where I'm located, and we definitely don't have unfinished ones. Would I do it to save money? If that were my way to getting in a house and I was okay with the unfinished basement, sure. I mean, I don't see why not. I know a lot of people over time end up finishing basements that are unfinished. So at some point, if you have the funds, want to finish it, it gives you an opportunity to do it. But it should reflect in your price, right? The unfinished basement should reflect in a lower price, and you should see what kind of value it adds to your property, and then you can decide whether or not you want to do it. But talk to an agent in your market that you're looking at to get, somebody that's local. It can give you a better idea of how that may affect you. Josh, you see anything here? We're an hour and 40 minutes in. We only have 109 likes. I mean, we had 400 people on here at the height of the show, and we didn't even get barely 25% of those people clicking the thumbs up. So it shows you, Josh, we're not really good at our job retaining people here. We just give out free information and they just use us.
Well, maybe they'll give you a like. Maybe they're off subscribing to the YouTube channel for the podcast.
No, probably not.
We actually do have a really good question. I like this question because it says that he went back and watched all the vetted VA lives in addition to these lives. So Shay has gone through all of Jeb's VA videos, nearly done with all the vetted VA lives that I host on Tuesday. I would like to refi to a VA. Wondered if I can request a VA inspection in advance to see what I need to do. That's a really good question. I don't know if you can go directly, because with a VA appraisal, so there's no such thing as a VA inspection. It's a VA appraisal. They appraise the property, they tell you the value, and they go through and they make sure that it meets the minimum property requirements that VA sets out, which are a little bit more stringent than conventional, but a little bit overblown. It shouldn't be a problem. Let me reach out.
Do a VA streamline and not have an appraisal?
He's looking to refi to a VA.
Oh, okay. Okay. Fair enough.
Yeah.
Okay.
Yeah. So if you have another type of loan and you want to do a VA refinance, then we absolutely need the appraisal. So reach out. my email is just josh@bywisemortgage.com. Shoot me that email and let me get you that answer. And if you want, we can get you connected. Jeb, do you have the link here? If you want a realtor connection, we can get you connected to someone in your area that can help and also answer that question for you.
Yeah, there you go. Scrolling the bottom of the screen. Now we have another question here, Josh, with regards to buying a house using a VA loan. Are there any benefits at the moment, or I guess, what are the benefits of waiting to buy if you're using a VA loan at the moment? Are there any?
So take VA out of it. I don't think it's any different in should I buy now or wait? We talk about this a million times. If it's the right time in your life, if you're stable in your work, you're stable in your relationship, you're stable in the number of children and dependents and co-inhabitors of your house, whether it's a parent that might need to move back in with you, you're not likely to need to move to another part of the country with your job. You have your finances in order. You have a good credit score. If all those things fall in line and you want to become a homeowner, there is no need to wait. I said, let's take the VA out of it. And I think kind of the question behind the question here with VA, most borrowers are not putting any money down. Does that represent additional risk? Yeah, it does. It's not a huge amount because let's be realistic. An FHA is 3.5% down. You have a little bit more than 2% equity once you put your funding fee, your mortgage insurance premium back in there. VA, you're going to be above that. If you're not exempt from the funding fee, you're going to put zero down and have somewhere between 1% and 3% added on to that. So you're technically upside down the second you own. So what I would say, what would be different? You would want to have an even longer time horizon to make sure you have the ability to pay the loan down and benefit from appreciation and allow there to be some fluctuations in the market. Jeb and I talk all the time. We don't believe there's going to be large scale decreases in home prices. That doesn't mean that there can't be some decrease in home prices or home prices in your local regional area. So just be careful with the VA, but the answer or the question that you need to be asking yourself is no different than anyone else. Is it the right time in my life to become a homeowner? The VA program is a hard-earned benefit, and it's one of the most amazing benefits that a veteran has. Far and away the best loan program out there.
All right, we're going to do one other question on VA here in just a minute. After I say thank you, guys, just went from 109 likes to 147 just by asking. So nearly 40 up just in that quick time frame. So thanks, guys. Darwin, if my brother-in-law is a veteran, can I qualify for a VA loan? So is it a family thing? Is it a personal thing? What happened?
No.
How's that work?
Let's say even if your brother-in-law wanted to buy with you, you can do a VA loan. You cannot do a zero down VA loan. Had a listener to the show a month or two ago was qualifying him and said, hey, my uncle's a veteran. He's never been a homeowner. He said, hey, he'd go in with me. And that way we don't have to come up with a down payment. And unfortunately, that is not how it works. The way, if you're borrowing with a veteran, I don't think that's what you're asking here. You're asking, can I get a VA loan because my brother-in-law was a veteran? And no, you can't. But if you wanted to buy together, essentially what it looks like is he can get zero down for his 50%. And what that represents is the VA guarantees 25% of the loan. So even though you put 0% down, the VA is coming behind you and saying, we will guarantee it as though you put 25% down. So what happens, your 50%, you're not a veteran, has no guarantee. You have to come in with 25% down on that portion of it. So 12.5, it actually rounds up. It ends up about 13% that you need to have. And on top of that, it's not eligible for automated underwriting and it has to go to VA for prior approval. So a little bit more complex. It can be done. I've done a few of them, but they don't come up super often.
All right, here's something I want to address really quick. It says the title is misleading. And the title of the video says the unaffordable housing market is here to stay. And I say that it's not misleading because I don't know how you get a more affordable housing market. Now, can rates improve a little bit to make it a little bit more affordable? Yes, that's not what we're talking about. We're talking about real affordability here. What creates that? Here's what I'll say. Rates go up higher. That makes payments even more unaffordable. Do prices come down during that time? Sure. But that impact on rates going higher has a bigger impact on your monthly payment, making it more unaffordable than that price coming down in most cases. If rates come down to make it more affordable, chances are buyer demand picks back up, puts some stabilization in home prices, which we've already seen will happen, which allows home prices not really to go any lower. In theory, keeping affordability at levels pretty close to where they are now. So yeah, it's a little bit misleading in the sense that, yeah, it says that it's here to stay, But I truly believe we have a problem, which we've discussed many times in the show, where I don't know how you can see mass big changes in affordability without a ton of more supply coming to the market, which I don't see any case in which that can happen anytime soon. All right, Josh, let's answer a couple more questions here.
Here's a good one. It's an easy one. Tyler says, thoughts on the rate buy down. Worth it to go from 6.5 to 5.5 for a couple thousand. So we don't know what the loan amount is. Let's say you have a $100,000 loan. $2,000 is 2 points. 2 points to go down 1%. That works out in your favor. In general, the rule of thumb says you're going to drop 0.25% in interest for every point that you pay. And with that, your break even is out about 5.5, 6 years. So for the most part, you have to be there in that home, in that loan, never sell or refinance longer than that to make it make sense. Now, are there times when the rate sheet looks goofy and maybe you can get 1% lower for, 2 points instead of 4 points that a full percent would normally drop, and now your break even is 2.5 years? It can absolutely make sense. So take the total amount of points and take your monthly payment savings and divide it by that, figure out what your break even is, and just determine how likely you are to be there. We've said probably 14 times tonight, you guys are tired of hearing it. I do think rates are going lower and there's going to be an opportunity to refinance. So in general, I'm not in favor of paying for a lower rate when I think we're going to get it, but there is certainty in getting that rate now and paying for it, that there is a value to. And if the cost is reasonable and the break even is short enough, you can absolutely justify it.
All right. And I know a lot of you guys had questions out there on rate buy down. So hopefully the point has been made on what Josh thinks of them in general. All right. There was a question here I wanted to answer real quick. Well, where was it? As a seller, how do you deal with an FHA appraisal coming in lower than what was offered in the contract? Why don't appraisals take into account the seller concessions? So how do you deal with it? Well, you have one of two options. You can negotiate and try to get the seller, the FHA buyer, up to your price. You can agree to their price. You can meet in the middle. There's no right or wrong way to address it, but I would say look at the demand in your market as a seller. If you're selling a property and you have no other offers, no other activity at all, and you finally got a buyer that's willing to put an offer in on your house that you've accepted, and the appraisal comes in less, my thought is, if you want to sell that house, it's your best benefit is to try to work with that potential buyer, because they've already shown interest in the property. They've already made an offer. They're already committed to some extent. Now, on the flip side, you have a line of buyers, now asking about your property or other offers that you didn't accept. Because of that, you can draw that line in the sand, play a little bit more hardball, if you will, and try to get that seller up. And if they don't, or that buyer up, and if they don't, you can move on to the next one. But you got to play the game, so to speak. So you got to decide what's right for you. I think it's always better to negotiate unless you have a backup plan. Now, in the case that it's a significant difference, that can be a little bit harder to swallow as a seller. So each case is going to be a little bit different, but just work with your lender and your real estate agent, and let them guide you through the process. So, Josh, yes, you were going to say something. I was going to exit the show.
Jay, just no, I don't want to go there. Jay said something. So Jay, I feel bad. It made me want to respond, but I don't want to go there. Let's give one last answer on the way out, Jeb. Daniel wants to know, Lennar said they'll buy the rate down out of their pocket. Does that sound right? Or will they just add it somewhere in the loan? Also, can I do FHA for a new construction home, down payment, closing assistance? Yes, you can do FHA for a new home. No problem with that. Most likely Lennar is being straight up, and they're saying, we want to make sure you're with our lender. We have it under control. And when we finish this house, that thing is ready to close 1-2 days later. So talk to an outside lender, compare the terms. What I can tell you is the majority of the people I'm talking to right now that are talking to a builder's lender, this is legit. The builders absolutely do want to control those deals, and they are making pretty big concessions.
All right, there you go. So guys, hour 52 on tonight. We appreciate you being here. We appreciate the support. If you need a lender, need a real estate agent anywhere in the country, there is a link scrolling the bottom of the screen right now. Happy to put you in touch with someone we know, like, and trust that can guide you through that process. So do me a favor and go to that website. If you haven't done so already, hit the thumbs up. Feel free to subscribe to the channel if you like this type of content. If you listen to podcasts, we're on Spotify, we're on Pocket Casts, we're on Apple, we're everywhere out there. The Educated Home Buyer is the podcast. It's separate from this show. It's even though this show comes on every Friday, every Tuesday is a different episode, deep dive, things you need to know to become an educated home buyer. There's also a YouTube channel for that. So go, be sure to check that out. Josh, final words tonight.
Let's hope that the next 7 days are less interesting than the last 7. How about that?
All right. That's a good way to end it. Till next